complexes in now close to 5 months, because for those who can afford, everything can be more or less arranged within their society. And so, even after containment measures have been gradually relaxed, because the health curve is still continuing to spread and keep rising, there's a lack of robust rebound in economic activity because there is a withdrawal, self imposed withdrawal of discretionary spending. Now, we do not know yet when the curve will subside uniformly across India. Nonetheless, we must look beyond, no matter how thick the fog of uncertainty around us at present. So, what does that mean to look beyond? In the short run, government expenditures are almost surely required to provide relief to the most affected citizenry and states. As we know, some states are more affected than others. Managing healthcare on the ground is a state level uh, decision and implementation. And many of these states are actually stretched for finances because the central government is itself stretched for finances, and the tax share that was supposed to go to the states has not yet actually reached many of them. So, in the short run, we need to find space for these expenditures. For the long run, government capital investments will be required for the universal provision of public goods such as health, education, and infrastructure. This is key because India needs to recover its growth path. And what is seen over a period of time is that simply giving subsidies and freebies to the citizens is not what actually creates sustainable growth, even though they may be attractive to roll out politically and they might make the recipients of the subsidies feel good in the short run. But ultimately, it's the quality of your healthcare, education, and infrastructure which seem to be more relevant for having long run growth path that's sustainable. So, both the need for short run expenditures and the need for long run investments in universal provision of public goods are essential to put India on a sustainable growth trajectory that is consistent with the needs of our demographics and aspirations. We can no longer afford to grow at 3%. We need much higher growth rate in order to create high skilled jobs for our youth. Now, in this journey, the private sector must not remain entirely crowded out. We will need its entrepreneurial spirit and productivity, which need to be recharged and allowed to blossom through non-public goods. Of course, they need to maintain desirable standards of governance and transparency in the process. And finally, all of this must be accomplished without taking undue macroeconomic and financial sector risks so that we avoid the mistakes of fiscal stimulus with poor credit underwriting that unfortunately took hold after the global financial crisis. So, government needs to undertake essential expenditures. For the long run, government needs to invest in health, education, and infrastructure. We need a thriving private sector whose activity is high and that's looking to make investments. And we need to make all of this happen without taking undue macroeconomic and financial sector risks. So, this is a tall order, no doubt. But can we make it happen in spite of the enormous challenges on the fiscal and financial stability? I believe we can. Clearly, fiscal and financial stability are not the only relevant issues. Much work is needed on the real side of the economy, structural reforms, especially on land, labor, and agri. But focus primarily on fiscal and financial stability fronts. Likely there are better ideas than what I'm going to suggest, and hopefully the system can debate these, figure out the right ideas, and proceed with the best ones. So, what I'm going to do next is talk about what the country requires on the fiscal front. I'll give a 5 point reform plan. And then I will talk about the financial side of things and again present a 5-point reform plan. So let me first talk about the fiscal. India needs fiscal institutional reforms with immediacy. Now, why is this the case? This is so because even prior to the outbreak of COVID 19, India was fiscally quite stretched. The government's fiscal deficit, which is what it spends over and above its revenues, so it has to generally rely on borrowings in order to fund these deficits, were already among the highest amongst the G20 countries. And on some consolidated measures, so if you accounted for it properly, this was already a double digit plus more than 10% of the GDP. So, why are fiscal institutional reforms needed with immediacy? Because in the short run, India needs to create fiscal space and even stretch the fiscal deficit a bit further, already beyond the existing stretch levels. However, this can be done only if it is not whiplashed violently by the markets when the government wants to go and borrow more. So the government needs to create fiscal space and stretch the fiscal a bit in the short run to undertake the necessary expenditures and infrastructure investments. But it must do so without losing credibility with investors and markets on the sustainability of its medium term debt levels. So, to this end, a 5-point reform agenda could be considered. First, a fiscal consolidation path needs to be reaffirmed in earnestness to achieve reasonable 3 to 5 year debt to GDP and fiscal deficit targets. These targets have been recommended by the Fiscal Responsibility and Budget Management Act of 2003 and its review in 2016. Why do the targets need to be reaffirmed in earnestness? Because unfortunately, there has been slippage on these targets in the past several years, and the slippage has often been managed through optics of accounting rather than through an honest acknowledgement that there has been slippage. So the rating agencies are concerned that the government doesn't always mean what it says, or as Dr. Reddy, the former governor of the RBI, puts in his masterful foreword to my book, that in India now there is an official fiscal deficit and we have a real fiscal deficit. And the gap between the two is so large that we have to now talk about both of these. So, a reaffirmation of a fiscal consolidation path is key, as several analysts estimate that even mild stress assumptions on the post COVID growth trajectory, as you know, the country is likely to experience a GDP contraction in 2021. So, even mild assumptions on the growth trajectory imply that India's debt to GDP numbers are likely to enter 80 to 90%. Now, these levels take us close to thresholds beyond which adverse growth dynamics tend to take over the economies. This has been documented in a long time series cross country historical data by economists Carmen Reinhardt and Kenneth Rogoff in their book, This Time is Different 8 Centuries of Financial Folly. What they document is that once a country's debt to GDP ratio starts getting above 90%, on average, it seems to be associated with a decline in the growth rates of the country from that point onwards. The simple reason is that the government is borrowing so much that it has to crowd out the rest of the private sector from borrowing in the markets, or the government now starts using the central bank to design rules that will keep government's costs of borrowing low at the cost of raising the costs of borrowing for the private sector. These kinds of crowding out phenomena can result in a reduction in the growth. So, since we are likely to see debt to GDP ratios in this range, we need to provide a medium term commitment that the country means business as far as consolidation of debt path in the medium term is concerned. Now, the second point is that merely having these FRBM targets in place has not sufficed to ensure adherence and lack of fiscal slippage, even in relatively less stressed years, that is, in the pre COVID era. Clearly, the FRBM targets have been there since 2003, and yet the slippages especially over the last decade, have been quite serious. Hence, objective monitoring of consolidated debt and deficit numbers is the need of the hour. Now, how can therefore we improve adherence to these fiscal targets? This can be achieved. One idea is that this can be achieved by setting up an independent bipartisan fiscal council. So, what is this council? Uh, the purpose of this council is to hold a mirror to the government's annual progress on FRBM targets and reflect it with authenticity to citizens at large. As I stressed, much of India's slippage has been managed through optical accounting, or, put simply, we have been doing fiscal jugards, as I like to think about it. You do above the line versus below the line, inside the balance sheet, outside the balance sheet. We sell one public sector enterprise to another public sector enterprise and pay a dividend to the government. But these are just musical chairs. You're not dealing with the fact that the true borrowing of the government is high. Now, this is not a new idea, the idea about a council that is independent, bipartisan, and presents a mirror to the government's progress. The 13th Finance Commission, as well as the FRBM Review Committee, recommended the appointment of a fiscal council, but they suggested that the council report to the financial ministry. Now, if you do that, such a council will cease to be independent because it will be essentially serving the interests of the present day government and is bound to fail in its disciplining role, no matter how well intentioned setting up such a council. So, in contrast to their recommendation, the report of the 14th Finance Commission, chaired again by former RBI Governor Dr. Y.V. Reddy, recommends that instead the FRBM Act be amended and it enable the Parliament to appoint a fiscal council. And what should this fiscal council do? It should undertake an ex ante assessment of the fiscal policy implications of government's annual budget proposals and their consistency with fiscal policy and rules. So the amendment is supposed to provide that the assessment that the council makes is actually tabled in both the houses of parliament. And if the government's budget at the time of its end of Jan, early Feb announcement is making extraordinary assumptions on growth, or it's not recognizing the true borrowings of the government by engaging in optics, then the council can make it public that its recommended assumptions and calculations are different than those of the government, and the parliament can be granted authority to enforce a comply or explain discipline on these budgetary assumptions. Okay, so what would the council do? The council would essentially provide a more timely and public recognition of the progress of the government on the FRBM targets. And when the slippage is very likely because extraordinary assumptions are being made to claim otherwise, we will know in a more timely manner that the budget has these problems. Now, third, it may take a while to get a fiscal council be set up, and yet, as Dr. Reddy points out, we need to know what the real deficit of the government is, what the true full consolidated borrowing of the government of India. So, India needs improved disclosure standards for government expenditure and deficit that preclude obfuscation of budgeting numbers. As I said, it's usually done through accounting jugaad or tricks. Such jugaad includes moving expenditures from before to immediately after the accounting date of 31st Jan, from above the line to below the line, from on balance sheet to off balance sheet, and so on. Now, what matters in the end to the economy is not this fiscal jugaad. Maybe it makes a particular ministry or an officer inside the finance ministry look good because optically he has managed not to show a slippage. But if the country as a whole is borrowing and financing its deficits, the true deficits in the markets, it is going to affect everyone's cost of borrowing because the government is borrowing too much relative to others in the economy. To this end, what has been suggested is that we accurately calculate a public sector borrowing requirement. So there's a concept of a PSBR. It is the borrowing requirement on a consolidated basis between the central government, all the state governments, and their respective owned enterprises. Who is the best positioned to provide this calculation? It's the Office of the Comptroller and Auditor General, the CAG of India, because they actually receive all this information and they can actually publish the PSBR on an annual basis for everyone to see. They can provide the details of the PSBR as well. An alternative could be that the CAG could make all pieces of individual data available to analysts and let them calculate different versions of the PSBR. Whichever way one goes about it, such transparency would pave way for a focus away from accounting sleight of hand towards fiscal management by the government in a true economic sense. Now, let me turn to the fourth point. So, the first 3 points were on a medium term consolidated path for the government expenditures, a fiscal council, and transparency of the public sector borrowing. Fourth point is on the composition of government expenditures. More than 90% of the central government's annual budget is allocated year after year to revenue expenditures, notably subsidies that have not been found to generate long run fiscal multiplier of growth. Studies at RBI seem to suggest that, in fact, subsidies just create a boost in the short term growth measurement. Even that is not always one for one because there's leakage in the transfer of subsidies, even though the leakages have reduced with the direct benefit and Aadhaar schemes. State budgets feature a somewhat higher allocation to capital expenditures. They are the ones who spend mostly on infrastructure. But even there, the revenue expenditures typically account for over 70% of the budgets. A substantial quantum of merit based subsidies needs to be phased out, especially the ones that are not delivering growth in an effective manner. And an interesting idea that has been proposed is that rather than delivering all these individual merit based subsidies, why don't we roll out a single universal basic income that is transferred directly to the citizens? And because now we have made such an impressive investment in providing Aadhaar or the unique identifiers, we have created millions of Jan Dhan Yojana bank accounts. So why don't we use this impressive investments to actually make the direct benefit transfers and let the citizens decide what they want to spend on? Do they want to hire a private tutor for their children, start a micro enterprise, pay down their debts, and so on? It is generally believed that this form of universal basic income can actually help compress the wasteful nature of several subsidies and thereby create space for reorientation of expenditure towards the public goods of healthcare, education, and especially infrastructure. These capital expenditures of the, say, the infrastructure type, they have been found in RBI research to have substantial multiplier effects on long-term growth, far in excess of one. For every dollar of, for every rupee of expenditure on infrastructure, the impact on growth, on long-term growth, is in excess of one. So that's a positive fiscal multiplier over and above what you spend. And the beauty about spending on healthcare, high quality universal education, and infrastructure is that it also has the potential to either crowd in private sector investment and, at a minimum, enhance its productivity and improve the ease of doing business. So that's point four, reorienting the composition of the expenditure. And the fifth point is that if you look at the revenue expenditures, in many cases, it's because the employment on the government's own balance sheets is very, very large. This is direct government employment. It is employment in public sector enterprises that the government owns. And all of this needs to be funded by the government through its borrowings because it's running deficits every year. And as I said, beyond a certain point, these deficits are not value enhancing for the economy. They are likely to actually cut back on growth. So there is an urgent need to recreate a substantial divestment program to shed government presence in sectors where private firms have the ability and the willingness to provide the needful for the economy. In fact, we had such a substantial divestment program that we can take inspiration from, which was the golden era of divestments during the 98 to 2003 period. These divestments were not just cosmetic musical chairs from one public sector enterprise to another. Economically meaningful divestments is what will improve the efficiency of public sector enterprises by allowing them to raise market financing, subject the enterprises to higher governance and performance standards, and unleash the repressed potential of its human capital. Such divestments, importantly, will also reduce the pressure on the government borrowing program because, in a way, it is raising equity financing when it divests rather than undertaking debt financing, which must be repaid at specific points of time. So, why is this 5 point agenda required as an institutional reform with urgency? Because in the recent past, the approach has been only to rely on attempts to boost tax revenues. That the fiscal woes don't have to be addressed by controlling expenditures, by reorienting expenditures, by better accounting, or by divestments. The primary focus on addressing the fisc has been only through boosting of tax revenue. Now, this strategy, unfortunately, is not working because unless you have a good tax collection and enforcement mechanism, it's very easy to do an arbitrage around tax rules or do tax evasion, to put it simply. The government's focus should therefore also be on expanding the pie. That is, uh, it should try, even if it retains the tax rate to where it is. If the economy grows, its tax collections will grow, and it'll be able to spend more. Right now, what is happening is that it's trying to get a larger and larger share of a shrinking pie because our growth is collapsing. And if the government does not course correct and wants to tax even more in a growth shrinking regime, most likely the pie will shrink even further because higher taxes will reduce incentives to make investments. Now, as I explain in the book's preface chapter, what I called as fiscal dominance, a theory of everything in India, just improving the fiscal condition in itself will restore financial stability in part in the country. Why? Because that will reduce the pressure on the government to dominate the financial sector rules and regulations, which are aimed at accommodating short run growth, but at the cost of long run objectives because banks are being asked to lend more than perhaps they can manage well. The government wants inflation to be sidestepped because it wants the central bank to keep interest rates low to help with its debt rollover problems. Or it wants to go and borrow abroad, even in a time of deteriorating fiscal conditions, but this could risk a fragility of external finance for the economy. Now, while fixing the fiscal situation will address the macro and very importantly, therefore, stabilize finances in the rest of the economy, the financial sector also needs direct reforms in order to aid economic recovery as and when post COVID growth impulses rebound in a durable manner. So, let me elaborate. I'm again going to present a 5 point agenda here. But the broad gist of these 5 points is the following. When it comes to buying a property, they say the criterion should be location, location, location. I say that when it comes to securing financial stability, the criterion should be capital, capital, capital. Capital is what is not borrowed money, it is equity investment. And what I've demonstrated at length in my research on India as well as in other parts of the world is that undercapitalized banks and financial institutions, so those that primarily rely on leverage or borrowed money such as deposits, commercial paper, wholesale market borrowings, such undercapitalized institutions that have very high asset risks relative to the amount of equity capital in their balance sheets, they do not lend well to healthier, productive parts of the economy. Instead, what they do is throw good money after the bad. They extend and pretend bad loans because they don't have enough loss absorption capacity. And because they are primarily lending to the defaulted firms, it vitiates credit culture in the economy because borrowers know that even if they make defaults on bank loans, the banks will be generous and forbearing in helping them tide over these situations. Now, therefore, as and when we recover from the pandemic, growth will need to be supported because we will need lending to happen to healthier individuals and healthier parts of the economy. And this can be guaranteed only if we have the support of well capitalized credit intermediaries, both banks and non banks. So, how can we make progress towards this? Point one, we have international Basel capital and liquidity standards. They need to be upheld in their full spirit for the entire banking system rather than be regularly softened through forbearances. Forbearances, which are concessions on these norms, should be exceptional and subject to a sunset clause of no longer than 6 months. In other words, forbearances should not become permanent dilutions of the norms. Now, of course, in the midst of COVID, debt moratoria have been imposed, corporate restructuring schemes have been proposed by the RBI in order to help the borrowers deal with the shock of the pandemic and the revenue and earnings hit that they have taken. However, it's not clear why the Insolvency and Bankruptcy Code has been suspended altogether for an entire year, because the restructuring schemes and debt moratoria that have been proposed apply only to banks, whereas even non-banks, such as insurance companies, debt liquid mutual funds, they also provide leverage to the borrowers in the economy. And RBI's policies don't apply to these borrowers, to these creditors. So the only way to resolve borrowers and facilitate restructuring when even non-banks are involved is to actually use the Insolvency and Bankruptcy Code. Perhaps a concession could be made for post-COVID IBC cases to allow the borrowers to retain control with some discretion being applied by the lenders as to whether to allow. Now, even leaving aside the issue of whether IBC should be reopened or not, the main issue is that debt moratoria and debt restructuring schemes for borrowers should not mean lack of adequate provisioning for the likely losses. The current 10% provisioning standard for assets in these restructuring schemes is simply too low, because in India, when banks make losses on loans, they recover barely in the range of 30 to 40 paisa on a rupee. So that's a loss of 60 to 70 paisa per rupee. And if you just provide 10% provisioning standard for such restructuring, it means that you are kicking the can down the road for ensuring that the banks are remaining well capitalized. Instead, the better thing to do is to actually aggressively provision upfront and ask banks to raise capital that will be required to absorb the losses. In my view, this needs to be done on a war footing for all banks. Some of the large private banks are already doing this on their own because the equity market conditions are still quite benign. In fact, equity markets are very close to their peak of pre-COVID days. And this could be tapped for even smaller banks and non-bank financial companies. I'll come to the issue of public sector banks later. Second, in addition to capitalization, it's important to account for losses there. How is this done globally now in the post-global financial crisis era? Annual asset quality reviews and macroprudential stress tests for banks and non-bank financial companies are conducted by regulators. Now, what is the conceptual idea? The idea is that finance is like a bridge from the savers to the borrowers, and the bridge should be able to withstand winds of very cyclonic style magnitudes. The bridge shouldn't collapse. The financial sector shouldn't collapse under slightly difficult wind situations. Now, engineers, of course, have figured this out, as you know. What do? They build enough buffers when they build bridges so that there is robustness in the construction of the bridge. The bridge is resilient to the kind of winds that can be considered as stressful scenarios. And they do this by ensuring there are enough trusses that will sort of help bear the pressures when the winds rise. The same needs to be done for the financial sector by raising the levels of capital to withstand losses that will arise in stressful macroeconomic situations. Now, the RBI already employs such methods implicitly in some of the internal workings. So, in its financial stability report, it has mentioned that the estimated gross non-performing assets ratio for the financial sector is likely to be between 12.5% to 15% under stress. In fact, this is less extreme than what many analysts are projecting. So these estimates should set the floor on the extent of capital that is required on bank and non-bank balance sheets. Why? Because a bridge should be able to carry the savings from the savers to the borrowers even under extreme conditions. It's not good enough that the bridge survives. It should continue to perform its function of providing this transfer of savings. Third, such capital requirements, so ones that will help you meet the kind of stress that COVID is likely to inflict as and when we emerge, the capital required to bear these losses is going to be hard to provide for public sector banks and government-owned non-bank finance companies because the government's fiscal situation is so stretched. So what's the way out? Just like the fifth point in the fiscal reform plan, divestments of government stakes below majority and down at least to 25% is required in public sector banks and government-owned non-bank finance companies, perhaps even insurance companies. This seems the only attractive, feasible option to actually raise capital. And I think the unions should be told this because otherwise they are going to end up with an entity which is basically a zombie entity. It's dead, but it's allowed to walk. But it's not good enough that you are alive. You actually have to be performing the bridge function of transferring the savings well. You can't just survive, you have to intermediate well. Now, such divestment has been recommended several times over the past 3 decades, notably by the Narasimham Committee and the PJ Nayak Committee. Of course, no government has adopted the proposals, but now there may be no option because we are running out of funds. In fact, I would favor a complete reprivatization of the healthier of the public sector banks. This will help them attract growth capital in time, improve management and human capital practices, embrace technology, including fintech innovations, and adopt better risk management standards. The weaker public sector banks may not find many suitors to buy the government equity stakes in the short run. Perhaps their business models can be reprioritized to make them microfinance style institutions This way, they can specialize in serving financial inclusion objectives, which is often the justification given for the presence of public sector banks. And if they specialize and uh, develop underwriting, monitoring, and collection expertise in microcredit, like other such institutions, they could make decent profit margins and then they could be reprivatized at better market value. Fourth, to the extent that government presence in the financial sector is there and will remain for some time, even if divestments and reprivatization are undertaken, regulation of banks and non bank financial companies can be made ownership neutral. The central bank must be allowed by law to exercise the same powers over all regulated entities, whether they are state owned or private. These would importantly involve the ability of the central bank that when you have undercapitalized government owned entities, maybe the management hasn't performed its function well, maybe the frauds at the bank have been very high, then the regulator should be able to replace management as they can with private sector banks. And we should consider whether the government should commit to an automatic dilution of its equity stakes if it can't inject capital. Because if it can't inject capital and it doesn't have the commitment to automatically dilute its equity stakes, it starts leaning on the central bank to relax the rules. And such fiscal dominance of the central bank leads to a dual control of these government entities and weakens the function of the central bank as a gatekeeper of financial stability. And fifth and final, inflation impulses in India are right now getting stronger since last 3 quarters. And this started actually pre-COVID. Post-COVID, supply-side pressures and induced cost push inflation have led to a further upward revision in inflation expectations of households and of analysts, both at home and abroad. Now, this is leading to a fairly tricky macroeconomic scenario. An increase in fiscal deficit in a time of rising inflation, negative real interest rates, and ultra loose liquidity conditions. All of this raised the prospect of a runaway inflation down the line. Now, this could occur in two ways. One, if credit growth picks up and the central bank chooses not to normalize monetary accommodation because it continues its focus on short term growth, or it gets fiscally dominated to keep government borrowing costs low. So either the central bank focuses on growth, or it is distracted away from inflation in helping the government keep borrowing costs low. So it basically doesn't exit the accommodative cycle in time. Then the credit growth, while picking up, could create an overheated economy, runaway inflation, and even the anticipation of such an outcome having become more likely can cause external investors to vote with their feet, resulting in a sudden stop of foreign financing and an associated currency depreciation spiral. Now, fortunately, flexible inflation targeting framework has been adopted in India since 2016. It is aimed precisely to avoid the central bank's interest rate decisions from being fiscally dominated. It has had a promising run in its first 4 years, and this framework needs to be persevered with because the gains from the framework will amplify over time once the central bank has developed adequate credibility that it is indeed focused on long run price stability. It is sensitive to growth, but it is also sensitive to price stability as its first and foremost primacy of that objective. And in fact, these gains can already be seen. The volatility of the Indian rupee has converged since 2014 to lower levels than it is for currencies of other emerging markets. And barring recent quarters, the household inflationary expectations have been relatively well anchored or been on a downward trajectory. And because inflation is not so high, Indian households are financializing their savings away from real estate holdings towards fixed income instruments and equity. So, to summarize, what are the 5 points on the financial side? capital, especially in the midst of COVID, to bear the likely losses going forward. Second, use stress tests in order to ensure resilience of the financial sector. Divest government stakes below majority and down at least to 25%, perhaps even reprivatize some public sector banks and NBFCs. Make regulation of banks and non-bank finance companies owned by governments ownership neutral, so put these on par with private banks. And finally, persevere with credibility of inflation targeting. Now, why are these fiscal and financial stability reforms necessary? Sometimes when you propose reforms in India, people have a tendency to say everything's going well. These are all impractical ideas. You're very academic in your thinking and so on. And my question to them is that I'll give an analogy, which is that India kept rationalizing the desirability of manufacturing the beautiful ambassador car, which didn't drive that well, because a vehicle that could drive faster and smoother was inappropriate for the Indian roads in 70s and 80s. Now, with all their current imperfections, the Indian roads have come a long way since. Unsurprisingly, therefore, the country is replete now with better cars, domestic and international. The same way, we need to recognize that a modernizing transformation is needed in India's financial sector, its regulations, and in the fiscal management. We are migrating from a centralized and nationalized era of the low growth, the so-called Hindu rate of growth of 3%, which we had in 70s and 80s, to a decentralized and private economy in parts, which wants to generate growth on the level of 7, 8, and aspirationally even 10%. Every crisis presents an opportunity. The unprecedented COVID shock should be used to acknowledge where the true states of our fiscal and financial stability stand, commit to bringing them where they need to be over the medium term, delineate a blueprint of the required economic and financial bridges, and rebuild these bridges pebble by pebble with transformational reforms. As I said, the bridges should be robust enough to withstand the hurricanes of future and yet continue to channel savings from one shore to the most productive users awaiting their arrival at the other shore. I cannot resist the temptation to end with a cricket analogy. It is on treacherous wickets that a sound batting technique is most necessary. And therefore, the right time to restore the institutional foundations of India's fiscal and financial stability is right now. Thank you. I'm happy to take some questions at this point.
Yeah, I think CR will ask questions.
Yeah.
On behalf of all the participants. Yes.
First of all, thank you so much, sir, for presenting the lecture on fiscal dominance, a theory of everything in India. So our students, they have posted me some questions. The first question is that the RBI in the recent report has claimed that the bad loans are going to increase as high as 12%. So can we expect a rise in the non-performing assets, as you have discussed as well, timely disclosure of defaults in your book? So is it going to be this way?
Yeah, I think it's a given, and it's not just in India. COVID shock and the lockdowns and just the reduction in the discretionary spend. See, what people are not fully appreciating is that even when lockdowns are relaxed, actually economic activity is not rebounding that strongly, and it's because a lot of individuals are not stepping out. So, just to give you the example of United States, COVID is a kind of pandemic that exposes the elderly the most in terms of fatality risk. So the elderly are not stepping out. Now, the demographics of the United States are such that close to 15 to 20% of the discretionary expenditure, what you can call as luxury, like, going to restaurant, going to theater, is actually undertaken by elderly. 15 to 20%. Now, this expenditure is not going to come back that quickly until a vaccine is actually delivered all over the country. So the revenue hit on corporations is bound to be there. Travel, hospitality sectors are unlikely to come back. In fact, Boeing is projecting that air travel will not go back to pre-COVID levels until 2023. So it's a given that there will be losses. In fact, whether see the losses will be there. The question is whether the central bank recognizes that the losses are there on the balance sheets of banks or not. And what I've been constantly trying to say is that it's better to actually over provide, or at least provide as much as you expect, because if you don't do that, then when the economy is coming out of COVID, you will have a banking sector that has to catch up so much on providing for the losses that you have not yet positioned it in a manner to have any capital to grow and lend to the healthier parts of the economy. And this has been India's problem in the financial sector all along. We are always fighting the last war. We still keep talking about the fact that we made bad loans during 2009 to 11 and 12. Why? That was 7 years back. We should have cleaned up the mess. We should have recognized, even if the assets are not resolved on ground, banks should have been asked to provide enough capital for these losses. And in fact, as I keep saying, the bridge needs to have even more trusses in order to bear further shocks, because only then it can perform the function of actually allowing vehicles to ride on it. The same way, a financial sector should not only have enough capital to withstand past losses, it needs to have adequate capital to withstand more losses, because only then it will extend credit to the healthier parts of the economy. So I think I would say that right now, given the benign equity market conditions, bank capital should be raised on a war footing to account for these double-digit losses that the RBI itself has projected in the financial stability report. And as I said, most analysts think is an underestimate, even though it is on the order of 12.5 to 15%. Many analysts think that the true number will actually be close to 18 to 20% if it is recognized correctly.
So the next question is from Shaurya Mishra. He is asking, would universal basic income negate the motivation to work?
Yes and no. I think the motivation to work goes away if you are given unemployment insurance, which is that, you don't get the money if you remain unemployed. If I just give a certain transfer to you, it's not clear to me that at the levels of poverty where we are, the incentives to work would actually go away. We are not going to be able to afford like a $600 a month kind of check. By the way, if I can just mention something funny, I actually received a financial assistance check from the government of India, because most of last year I was from the government of the United States, because most of last year I was in India and my income was very low. So they actually gave me a financial support to tide over the COVID. The reason why I say it is that this is very excessive. For someone like me to be receiving a check from the government of the United States is very excessive. We are not going to be able to provide that kind of universal basic income to our citizens. So we are talking about just the bare essential to get people going. But right now, what happens is that politically, it's more attractive if you can have a billboard that says you gave gas, or you gave you can name every individual scheme with an interesting title, and then it becomes a more interesting political advertising. But I think it's not efficient. I think it's better to let the individual decide what they want to spend the money on, because once they have the money and they have the demand for the services, the private sector can figure out who to give gas to. It's not that rocket science to deliver. Indian fast moving consumer goods are selling shampoos and soaps and sachets in every hinterland of the country. So if the demand is there, at the end of the day, the private sector will figure out how to deliver the services.
Yes, sir. So the next question is from Kosta Pradhan. He's asking, as we have discussed about the capital spending in our lecture, that how it's not backed by the borrowing. So is there a healthy medium between revenue spending and the capital spending like India? And is there any short-term and the long-term effect associated with the capital spending as well?
That's a good point. I just think that the present numbers are just abysmally low. If you take health, education, and infrastructure, we spend less than 10% of the government's expenditures in a year on these things. And that's just extraordinarily low. So I think we are trying to do too much of a welfare state, in my view, which sort of provides for a lot of consumption needs of the economy without actually trying to ensure that we are on a path to become very rich very soon in the first place. Uh, and as I said, to do that, you need infrastructure. This is not to say that infrastructure spending by government can't go bad. China is a good example. China spends a lot of money on infrastructure through its public sector banks as well. And, it has created these so-called ghost cities. So there are cities in China where you have 4 to 5 times the capacity in the city compared to the number of people living there. So when you walk through it, they feel like ghost towns because three-fourths of the town actually has nothing happening or no one living there. Nevertheless, I think we are at the other extreme in my view, and so we need to do more. Also, infrastructure, as I said, is likely to not just create long-run growth; it will also crowd in private sector. It will, if you build good roads, it can lead to an industrial corridor along the way. If you make good roads outside cities, maybe IT parks could easily come up there, and maybe that can help with creation of more high skilled jobs in the country. So there's lots of other positive externalities or spillovers from infrastructure, and. So, in a way, what we have done in education is we have had too much of private provision of education with not enough high standards. And so we could have perhaps focused a little bit more on maybe providing universal education at the lower level. See, we now have like an overabundance of private universities, colleges, and so on, not necessarily with the highest standards, but we have not yet universalized basic primary and secondary education. And so sometimes, it's a lack of priorities. And why? Because, the gains to education are very long term and it's not as tangible, and I think that's the problem. I think that we need to at least I would say we need to go at least 50-50. There is always this concern raised that where is the compression possible? How can you reduce pensions and salaried employees? But you have so much pension and salaried employee bill is because you have so much public sector enterprises that are owned by the government. Divest stakes and let that burden of employee compensation be transferred to the private sector. The government doesn't have to be in a borrowing spree at a point where it's not able to borrow anymore at reasonable costs. And worse, it is actually crowding out others. Who might be able to borrow. And you can take so many institutions that have run into this problem. Just look at Air India. Air India is actually one of the largest quote unquote non-performing asset of the country, right? Means, without government support, it would not be functioning as a thriving airline. But right now, Air India's debts are higher than 50,000 crores. And so the question is, yes, you have created employment, but is it high quality employment, and at what cost? I think that's the question we need to ask.
Sir, the next question is from Shweta Shetty. She's asking, as many of the experts are claiming that the growth after the COVID period is going to be a U shape or a V shape. So what's your take on this? Is it going to be V, U, or I?
I'm not good at predicting things, but all that I know is that future is very uncertain. I think no one can be sure right now. I think even like predicting growth is not easy even in good times. But right now, the scale of uncertainty is very, very high because it's a very in a way, the pandemic is it's a very intrusive shock because it has crippled human activity at its core. A lot of the things we like to do is about being social. That's a very intrinsic desire of a human being to socialize, and the pandemic has hit that at its core. And not just that, it has restricted global mobility, as we were discussing the travel sector, etc., in such a significant way. And then there are so many multiple layers of spillovers from all this that I think we are looking. If someone had to force me to make a conjecture, I think my sense is it's going to be a very slow, protracted recovery. It's because everyone has borrowed very heavily in parts of the world where borrowing wasn't high to start with. They are borrowing even more because the central banks are making it cheap for them to borrow. In India, we were heavily indebted even to start with. And so much debt with weaker growth prospects is going to slow down things. And at the same time, in countries such as India, we have supply side pressures because of the pandemic that are already causing goods to be at inflated prices. Unfortunately, there is a Cold War going on with China in different parts of the world. And whether we like it or not, every country is importing massively from China its manufactured products. So if they try to shift out of that, there will be at least be several years of inflation that comes into play when you try to figure out if you're not going to get goods from China, where are you going to get these goods from? So I'm actually not just concerned about lack of a fast growth. I'm actually concerned about lack of a fast growth that's accompanied with rising inflation. So I'm worried about stagflation kind of forces at work in emerging markets such as India. Inflation is benign in developed economies, but even there is a concern that given the level of monetary and fiscal stimulus, as and when the pandemic settles down, it could lead to a very quick, rapid rise in inflation. So I think I would say the focus should be not just on growth, but also on inflation and its dynamics in the near future.
Thank you, sir. So the next question is from Anshul Agrawal. He's asking a question from NK Singh Committee. He's asking, were the fiscal deficit targets given by NK Singh Committee were honest? And if yes, we see that the government was initially moving on a fiscally disciplined path, but in order to create infrastructure crucial for the development of India, doesn't it become imperative for the government to spend more?
Means it could be that government needs to spend more, and my sense is that if the spending is generating growth, your debt to GDP numbers won't look too bad. But the fact that the debt to GDP numbers are experiencing strain is suggestive that actually growth is declining and your borrowings are rising. And that's a bad mix basically. That's why I'm for reorientation of expenditure, because I think spending on infrastructure will actually create growth. And see, once you reach 85-90% debt to GDP levels, you have to rein in both. You have to work on both numerator and the denominator. You have to cut down debt, and simultaneously you have to boost GDP. Because if you try to boost GDP just by taking on more debt, and if your growth doesn't materialize, now we have taken on even higher leverage in the process. So, we have not left any buffers actually to respond counter-cyclically. Therefore, the adjustments have to be tough. I think there is no way out.
Just last question, Swati.
Yes, please.
So I'll be taking last question, sir. So is it from Hari Deepak? He's asking, is it possible for RBI to encourage citizens to save while controlling inflation and making credit available to weaker section of the society in this challenging modern economic scenario?
Yeah, that's a great question. We had a visitor who's the managing director of Bank for International Settlements, Augustine Carstens, when I was at the RBI. Governor Das had invited him for a talk. He is the former finance minister as well as governor of the Bank of Mexico. Central Bank of Mexico. And what he said is that the best thing a central bank can do is to actually keep the macroeconomy stable, keep inflation down. Because if you keep inflation down, actually the uncertainty about your savings eroding comes down. And therefore, you are likely to make financial savings rather than invest in real estate, gold, and so on. The household finance committee report chaired by the Professor Tarun Ramaswamy from Imperial College for India, it showed that in the numbers they looked at, more than 80% of wealth of Indians is actually locked up in real estate and gold. And this means that savings can't be easily channeled to those who need to make investments, because I can't use real estate to invest unless I can borrow heavily against it. But if I have to borrow to heavily invest, I become a very heavily borrowed entrepreneur rather than someone who can rely on just financial forms of capital. So I think keeping inflation at bay, in my view, is actually one of the most important functions a central bank can perform to boost and encourage financial savings in the economy. In the preface chapter of the book, I talk quite a bit, not quite a bit, but I make this significant point that one of the reasons why fiscal dominance of the central bank is seeing a resurgence in India is because until the global financial crisis, we had high growth. The government balance sheets were on the consolidation path because of improvement in tax revenues, and the household savings rate was actually rising. And these benign conditions all started reversing after the global financial crisis. Growth slowed down in the short run, in the long run. In the short run, some stimulus was undertaken, but as we know, it wasn't very sustainable. The government deficit started slipping because as the growth slowed down, governments wanted to do more and more in order to show that the growth numbers remain high. And because we have now started pushing so much household credit through credit cards, through mortgages, etc., that households are actually consuming on borrowed money. And that has reduced their desire actually to save, because you are actually consuming with someone else's money. It's, you are borrowing your assets, and more and more money is becoming available for retail individuals to borrow. So, in all these conditions reversed, and therefore the government borrowing is rising, the household savings are declining, and so the pressure on the government costs of borrowing are high. If government wants to do more in order to support short-term or long-run growth, it's not that easy anymore. And then they start turning to the central bank to facilitate banks to do some of their government agenda, and to relax rules so that the government can keep borrowing at low rates and so on. So I think this is a very interesting question. The paradox is the following. At one level, we nationalized banks in 60s and 70s. And what was the complaint that the politicians had? The politicians had the complaints that, we are a poor economy. We need a development agenda. We need financial inclusion agenda. And lo and behold, these banks are lending primarily to the industrial houses. That was sort of the underlying narrative of the nationalization. And today we have a problem with our public sector banks because they primarily lend to these industrialists. So, we nationalized these banks in the hope that they were going to perform development and financial inclusion functions. But in the end, that's not the kind of loans that have gone bad. The loans that have gone bad are actually loans to exactly the same kind of private sector firms that we were complaining that these banks were lending to in the first place. Credit to GDP in the country is still below 60%. If you go to parts of Northeast India, there are regions where it's less than 5% of the regional GDP. So the penetration of credit at the grassroots level is not that high. And I think a part of the problem is because the public sector banks are not very specialized. it's a nice sentence to say that, oh, we are a poor country and we need financial inclusion and therefore we need public sector banks. But no, in 50 years, why don't you give me a scorecard of what financial inclusion was achieved and how our credit to GDP ratio improved over this point of time? So I think that if we want to continue with some of the public sector banks because we can't reprivatize them or don't want to divest the stakes, then I think we seriously need to reprioritize their business model so that they are actually doing the function for which nationalization was undertaken in the first place. In the book, there is a very short two-page essay that I had put out in Financial Times when it was running a special series on India. And it's called What Can India's Banks Learn from the Shampoo Sachet Revolution of the 70s? So in 70s, the fast-moving consumer good companies, they figured out that a poor person in India can't buy the shampoo bottle that's this big. It's too expensive for them. They can't actually buy their needs for the next 6 months or 1 year in one go. And so therefore they came out with this idea of the very small soap sizes and shampoo sachets, where you open it, you use it once, and that's it. And then lo and behold, even the poor person in India could actually afford washing their hair with the best shampoos that were around. I think the same way our banks need to embrace technology that is suitable for lending at the last mile. The last mile borrower doesn't have assets. They don't have physical assets, but they are doing financial transactions. In fact, their churn in financing is very high because what they earn, they by and large spend. So in a percentage sense, their cash flow churning is very, very high. So if banks can go to the last mile and get records of these cash flows, maybe because maybe you start using data from wallets or digilockers or something like that in order to get this information. Maybe they can connect to the utility bill payments in order to get information from there. At a slightly higher level than the last mile, maybe there are now records of GST invoices of some of the micro and medium sized enterprises. And maybe all of these cash flow based information could be used to design efficient loans of the right size and right maturities at the last mile. But that requires a specialization in this form of lending, and we have microcredit institutions that do that. In fact, one of the banks, Bandhan Bank, was a microcredit institution that has exactly this kind of last mile lending model, and it's generating extremely high intermediation margins. So I think the profits are there, the money is there from channeling the savings to the right borrowers. And I think if we reprioritize some of the public sector banks, we might be able to achieve this.
Thank you, Professor Viral, for your extensive talk on this topic. I would request Professor Abhinava Tripathi to formally present vote of thanks.
Thank you, sir. So, I hope am I audible?
Yes.
On behalf of IIT Roorkee, we thank Professor Viral for taking this session and sharing valuable insights with us on a very important topic, that is quest for restoring financial stability in India. In fact, I think that is the same topic of his book also. Also, in fact, I was quite delighted when we got your response on our mail agreeing to conduct this session. And in this discussion, you raised a number of important points, particularly related to the challenges faced by Indian economy on fiscal and financial stability front, and their increasing relevance during the times of COVID-19. You also highlighted the need for fiscal and financial reforms through the 5-point reform formula that noted by you. For our audience benefit, I'll just quickly repeat these 5 points. So first, you noted the need for medium-term fiscal consolidation to improve the fiscal deficit targets, for example, debt to GDP ratio. You also highlighted the need to improve the adherence to fiscal targets by setting up an independent bipartisan fiscal council. Third, you highlighted the importance of improving the disclosure standards for government borrowing requirements and expenditure. You also noted the need for reorienting the composition of government expenditure. For example, you highlighted the need for phasing out certain subsidiaries and focusing more on capital expenditure on infrastructure. You also noted the need for rolling out single basic universal income scheme using Aadhaar and other identifiers such by conducting direct benefit transfer. Lastly, you mentioned the need for divestment programs to reduce borrowing and investment burden from government and invite more private investment, which may be more efficient. So overall, this session has made a valuable contribution to our understanding of the Indian economy and financial system. In closing, once again, we at IIT Roorkee extend our heartfelt thanks for taking out time from your busy schedule and conducting a very thought-provoking and engaging session. I'm quite sure that most of us would be intrigued by this session and would like to read your book to explore this subject further. And I'm hoping, in fact, we would be definitely looking forward to more such opportunities to interact with you, maybe possibly through different channels like these webinars and probably some other such collaborations if possible to get valuable insights from the extensive body of your research work. Thanking you, sir. So I close from my side.
Thank you so much, sir.